I'm Amy Shapiro, and I'm the Business Development Director here at the Franklin County CDC. We've been conducting interviews with business owners for the last 6 months, and what has bubbled up is topics on how to value your business, how to increase value in your business that's non-financial, and then how to sell your business. Whether you're selling it 3 years from now, 10 years from now, how do I prepare my business so that I can develop a plan to help me with the next transition? So we've created these 3 workshops, and today's workshop is valuing your small business. We're fortunate to have Karen from Melanson and Heath, who's joined us and is an expert in business valuation. And so I'm going to turn it over to Karen.
Great. Welcome. We're going to talk about, as Amy mentioned, we're going to talk about what is your company worth, or how do you value a company, and we'll look at it from a few angles, because maybe you want to know what your company's worth. Maybe you want to take on a partner. Maybe you want to sell part of your business to one of your children, or maybe you're looking to sell your entire business. Or maybe you're looking to purchase a business and you want to know how much that business is worth. So this is kind of covering all of those realms and looking at what are the purposes of valuation, why might you want to do a valuation, and importantly, probably the biggest question for a lot of you is, how do you increase value? Perhaps you're not ready now to sell, but if you want to sell in the future, how does that value increase? And when I talk to people, who are starting out in business, and we help people start up, we really urge them to talk about what their end game is. So even if you think you're going to be in business for 50 years, what's your goal to get out of the business? Because that really should be on people's minds. Sounds negative or sounds, doomsday. It's not. You're getting into business, you have to have an end game. Are you looking to retire? Are you looking to have a legacy that you pass on to your children? Are you looking to sell to a bigger company and net a bunch of money? What are you looking for? And it's different for everybody. So it's important to know that. Some people are truly looking for a paycheck, and they're looking to just be done at the end of the day. So it really depends on each individual. And as we go along, please feel free to just jump in, ask questions. I want to make this interactive. So we'll first talk about the 3 fundamental approaches to valuing a business. So there's probably 20 plus more methods that you can use, but they all fall under 3 major approaches. So you have the asset approach, the income approach, and the market approach. The asset approach values a business based on the company's tangible and intangible assets. So if you think about your company's financial statements, we're kind of talking about the balance sheet, but at fair market value. You're buying your assets at cost and depreciating them. So you're going to have to look at the fair market value of your assets, but that's really what we're looking at here. So I would say most businesses, the value's not in their assets. Not always the case, but most businesses, the value is in the money that the assets generate, the operations that the assets generate. So we look at this method, and it's required in certain instances, but oftentimes this isn't where the real value stands. The income approach, I would say, is the most, I don't want to say most commonly used, but for small businesses, the approach that makes the most sense. This is the value based on the ability of the company to generate desired economic benefit for the owners. So what does that mean? Cash to the owners, or however you want to have that economic benefit. Maybe your economic benefit is having certain benefits through the company, so it's not necessarily cash, but if you really think about it, the whole purpose is so that you can thrive as a business owner if you're in a for-profit business. So here, a few of the major methods: discounted cash flow, capitalization of earnings, and multiple discretionary earnings. So we'll look at each of those. We'll also talk and look at some unofficial ways to value your business. And it's important to know, I'm not suggesting that you should use those, and you'll see disclaimers, but they're great for businesses such as yourself that might be just kind of dabbling and kind of want to see what the value is, but don't want to spend the money right now. You just want a basic idea. We'll give you some of that as well. And then the market approach is the value based on selling price of similar items. So I think most commonly what people can relate that to is if you're selling your house. You'll go out, you'll get comparable sales of other houses. That's what the market approach does. So what other businesses have sold in the area? what did they sell for, how comparable are those businesses to your business, and what's the value of your business. Much less commonly used. Common in big businesses, and you have to review the approach for certain valuations, but it's just not practical in many cases because you have a hair salon in town doesn't mean another hair salon in town sold and you have that data. So we have big databases that we can use, and we're going to do a case study in a little bit, and that will go through an example. But as you'll see from that case study, I think there was no comparable sales in the state. If there was maybe one. It's difficult to use that data. And when you're using big data sources, they're usually bigger companies, often publicly traded. It's just you're comparing apples to oranges. So it's a difficult comparison. It's good for just to get the information and to have the information, but good comparisons aren't typically made. So the capitalization of earnings method, this is a method very commonly used for kind of mature, established businesses. So the relatively stable levels of margins and growth. So you can take a look back I tend to look at 5 years, 3 years is often typical as well, but take a look back over those years and say things are pretty stable, things are pretty even. If that's the case, the capitalization of earnings method might make a lot of sense. We're saying in that past performance is indicative of the future performance. So we're saying this is what happened, say the past 3 to 5 years. That's pretty much what's going to happen going forward. We take those 5 years and we capitalize it to a single period. So we say, all right, looking at those years, do we weight them all the same? Are they pretty equal? Are the most current years more relevant? Which is what we would be doing in that case. You've really made some changes. Maybe we don't even weight maybe we only wait 2 years because those other 3 years just aren't indicative anymore. I would say as you're going forward, you would definitely want to have 2 years of good performance. As somebody that represents buyers and sellers, I wouldn't want to go in and see just 1 year of change because I would think, okay, that's great, but is it sustainable? 2 years of change, now we're saying, okay, that's a little more sustainable. I think the other thing that happens too is 1 major year change, people go in and go, what are you doing? Are you playing with your numbers? How did they make this year look better just because they're selling? So that's why you really want to have a few years to show that those changes are sustainable. So we take that single benefits stream and we capitalize it by a risk-adjusted rate of return. So we won't this isn't, an advanced class in valuation, so I'm not going to get real detailed about it, but just to show you the basics of how it works. The capitalization rate is included the cost of equity, a risk-free rate of return, equity risk premium, industry risk premium, size premium, and specific company risk. And we'll talk about these because we'll go through that case study and see how we build it up a little bit. But basically, important ones, they're all important, but these are going to be pretty consistent no matter which company you have. So that's going to be about the same. It might differ depending on the structure of the company, how much of the company is financed by equity, how much is financed by debt. So it'll change a bit, but the big ones here are industry risk. So different industries are going to have a different amount of risk. Size premium, I just include that in the specific company risk, but that is where we really look at your company. What are the risks? What are the benefits of your company? What makes your company different than other companies in your industry? And that's where business valuation really is, it's part science, part art. There's a lot of subjectivity to it because maybe I think your business is less risky than the next valuation analyst. So it really takes, to come to a true value, it really takes a lot of sitting down and talking to the owners and truly understanding the company and the business. So discounted cash flow method. So this is very similar to capitalization of earnings method, but the difference is that we can be a lot more flexible in this method. So it allows for variations in your margins. It allows variations in your growth rates, your debt repayments. So instead of taking the past 5 years and coming up with a normalized rate and capitalizing it, we're looking forward more and saying, okay, maybe your margins aren't going to be that steady rate. Maybe they're going to increase 10% this year, 5% the next year, and then 2% into perpetuity. With the capitalization of earnings rate, we're looking at one growth rate. We're saying it's going to be X amount forever. Usually that rate's not more than 3%, typically is what we do, because you are truly looking forever. It's into perpetuity. Sometimes it's 0, sometimes it's 1%. It depends really on the company and on the industry. But this allows you to change that and really estimate out, okay, what are the differences in your company? Why might it be different? Let's say you are that company that works now to change things for 2 years. Well, you know that some of those changes are going to make much bigger increases over the next 2 years. Then we want this method. We don't want to just capitalize the current earnings. And that does give value for a new buyer, because if you brought in new contracts that are going to continue, that's worth more. That's different than just having the buyer change things. Used typically for less mature companies, and that's because, as we said, mature companies, they're kind of stable now. They've hit their peak, they're just kind of running along, maybe increasing at, the cost of living rate perhaps, but they're stable. You'll hear, if you hear the words discount rate and capitalization rate, they're certainly not the same thing. They're sometimes used interchangeably. The difference is the discount rate minus the growth rate is the capitalization rate. So when we use a capitalization rate, we add a growth rate on top of it. So that's just the difference between those two terms when you hear them. Common income approaches. So this one is multiple of discretionary earnings. And I would say this is typically called the rule of thumb. Now you can also use this kind of in a market approach, but this is one where we put our big disclaimer out there. This is not a true valuation method. This is just a guide. It's not a substitute for a true valuation. However, if you're looking at just merger and acquisition, sounds like a big term. It just means you might be looking to take on a partner or sell your company to someone down the street. It's not. I think people think of merger and acquisition as, big conglomerates getting together, and that's just not. It fits for all size businesses, so don't be scared of that term, let's say. But the rule of thumb can give you a good guide to say, okay, what might my company be worth if I'm looking to sell? Or if I'm looking to merge with someone else, what might a hairdresser, what might the hairdresser down the street be worth? This could give you a guide in lieu of having a big valuation. And I would say if you go to a broker to have your business sold, often that's what they'll look at. They'll look at some sort of a method like this. So you apply your selected multiple, and we'll look at what those multiples are. They're published multiples by your earnings rate. There's all different kinds of earnings you can use, but the multiple tells you specifically what earnings method. So whether it's EBITDA, the earnings before interest, taxes, depreciation, and amortization, whether it's normalized earnings, and we'll talk about normalized earnings and what we do to normalize earnings, which is one of the things you want to do because it increases your value for the buyer with what you're doing. And then your seller's discretionary earnings. So that's basically taking your normalized earnings and adding back the owner's salary. The owners took out X amount, that's discretionary. That's money available to a new buyer. So I'm going to officially label these unofficial techniques for valuing a business. So I'm not saying these are valuation techniques, but these are a good way to get an estimate of what your company might be worth as you start the process. Or if you're in the process now and thinking, I want to sell in a year, I want to sell in 5 years, 10 years, these are great guides to start you thinking. These are published by it's called Business Reference Guide. It's published by the Business Brokerage Press. And this is truly what it looks like. This is how it comes. You search for your industry. It gives you the industry description. I'm using a flower shop, which is what we're going to use for the case study. So we go into the guide and it says, here's your rule of thumb. A flower shop, typically on average, will sell at 30 to 35% of annual sales, which includes inventory. And it's important to understand and note truly what they're saying. That's saying your sales are $100,000, your business should be sold for $30,000 to $35,000 with the inventory included. Or 2 times EBITDA, the earnings before interest, taxes, depreciation, and amortization. And as you'll see in the example I give you, those could be widely ranging numbers. So this is where it's just a starting point. It's a starting point to understanding. I talked to someone who has a florist shop that said, man, I don't know about that. I own greenhouses and I have, okay, that's different. I would say that doesn't include inventory. I think when we're looking at an industry and we're including inventory, we're looking at cut flowers. We're looking at perishables that are going to go away. That's why it's not worth a whole lot more than the business itself. If you have greenhouses and you have flowers that you're cultivating, that's different. That might be adding value. And that gets down to why you really want to sit and understand the business and understand the business owner. You can't just say, oh, it's a flower shop and here's the value. Now, this one, I truly just Googled these before preparing the presentation, so I cannot vouch for these sites at all. So I'm not endorsing them, but I want you to know that this sort of thing is out there. So there's some do-it-yourself websites that I found, fitsmallbusiness.com, exitadvisor.com. We'll look at them for our case study with the florist shop. It was fun to play around with and certainly interesting. One of them, I think it was Fit Small Business, doesn't even ask for the industry that you're in, but one of them came out with a value pretty close to the rule of thumb. So my guess is that's what they're using as their base. But another good, it's free. Might as well go and play around with it at least to see what it tells you. Can't hurt to at least understand the options. But just know that I'm not endorsing them. I don't know who they are. They could be completely off base. I don't know. So let's talk about the levels of valuation. So now, I'm a certified valuation analyst, so I do true business valuations, which are costly, depending on who you are, but I consider it costly for most businesses. So a true expert business valuation is probably $8,000 to $15,000. We tend to charge a flat fee just a little under $10,000. But we're doing this for things like larger companies with gift and estate tax issues. So when you're reporting to the IRS, you have to follow Revenue Ruling 5960. You have to follow their guidelines. You have to look at every single method. So this is not for everybody. This is not for somebody who's thinking, oh, let's kind of see what my value's worth. This is for when you might be going to court. Perhaps there's divorce implications. And it's a very contentious divorce and it might be going to court. Okay, now you might need the full valuation. But that's not common. I just want you to know. It is common, actually. It's very common. But not common for smaller business owners who are just looking to get a feel for value. Not worth spending the money in those realms. So these also have to be done by someone who's certified in business valuation, depending on the reason. So like if you're going to do loan funding with the bank, 704B, it has to be prepared by somebody that's either a certified valuation analyst, accredited in business valuation, or ASA, accredited senior appraiser. That's a relatively new regulation. It used to be, the SBA used to allow CPAs to do them. Now they have to be accredited in valuation. So that's a change that will add to the cost of loan funding. So it's just important to know that. Depending on who you ask, which credential is which, some people get all of them. I have just the CBA. I don't really have an urge to have 50,000 initials and pay all the fees. So, it depends on who you ask, which one's better or not better. I feel that if somebody's doing valuations and they're doing the methods appropriately, they're all kind of equal. I wouldn't shy away from any of the credentials. I think they're fine. Calculation of value. So this is kind of our next level of service that I would say goes from about $3,000 to $8,000 depending. We charge a little under $5,000 typically. The reason we do a flat fee is we don't like people that not know what they're getting into. I hate it when clients feel like they're getting nickeled and dimed and they don't want to call because it's going to be another 15-minute charge. So that's how we do it. But you'll find different some people will just do hourly rates. It really depends on who you work with. So, but the calculation of value is a lower level value. It's not giving an opinion. It's giving a calculation of value, an estimate of the value of the business. And one of the major differences is that we're not necessarily taking into account all three methods. We might sit down and say, listen, the income approach makes the most sense for you. You know, we know your assets aren't worth it. We know we don't have comparable sales in the industry. Let's do just the income approach. Let's scale down what we're doing. I don't know if any of you have bank loan funding and have to do financial statements, but it's very similar to that. So if you go to the bank and you ask for a loan, they might want internally prepared financial statements. That's you just printing it off your accounting software. They might want a compilation, which is your accountant just kind of printing it off your software. Not really, but doing a little bit of work. Or they might want a review where the accountant's looking more at the numbers and doing analysis. Or they might want an audit, which is significantly more in scope. That's kind of how you can think about the valuations. It really depends on the scope of the size of what you're looking to do. The loan funding from the bank, obviously, the bigger risk for the bank and the bigger company, the higher level of service they want. Then there's a letter report on a calculation of value. We do this often for banks, and typically it's around the $2,500 charge. That's typically the flat fee. That's where maybe the bank's using the SBA, but it's not as significant. You know, either they're an express lender for the SBA, and the SBA is trusting the banker to know what they're looking at and understanding. Or perhaps the bank itself just wants to get an idea of the value, even no SBA involved. So we can do a letter report. And then the last method, value consulting. And here again, merger and acquisition consulting. But don't be scared by that term, because that doesn't mean you're a big conglomerate. It just means you're trying to figure out your options. Are you selling to a partner? Are you selling to a child? Are you gifting away? That's merger and acquisition. And typically that's at hourly rates. That's how we do it, because we say, okay, you don't need to pay me even $1,500. Maybe you need to sit down for an hour and just talk about what you're looking to accomplish and get some basic numbers on what your business is worth. Then, you know, pay somebody $150, $200 an hour for an hour or two and be done. And then follow up later on if you need. So that's often where a lot of the small businesses will start, because you just don't need that yet. You're not at that point. So steps to valuation. So here's what we go through. In general, this is really basic kind of overview, but here's the steps to the valuation. We're obtaining a history of the company. So we're understanding what is your company, what industry are you in, what has been your history, you know, how has management gone throughout the years, is it one owner for 50 years, has it changed hands a lot, just really understanding the business and how it operates, how it works, you know, is there an accounting staff, is there a CEO or CFO, is the owner the bookkeeper, you know, which is common, so that just understanding the history of the company. Then, of course, gathering financial information, typically 3 to 5 years of tax returns. For companies that are a bit larger, the financial statements if they're provided for a bank. Almost always, or always ask for current financial statements year to date, but management prepared, you know, printing off of your software, or if you use a ledger book by hand, we'd want to see that and go through your numbers year to date. I would say if you're doing something manual like that and looking to sell, you want to automate. That's something that makes your business more valuable and more reliable. The records are more reliable to somebody looking to buy. Interview management and key employees. So part of why we like to gather the financial information first, and it can be all at the same time in the first meeting, but that financial information really brings up a lot of questions, you know, and they're not threatening questions and they're not accusatory questions. They're just getting to know your business. You know, why are your margins like this? And what are you doing with this expense? And that can be hard for business owners sometimes, especially if you're looking like in a divorce context, because people are like, why are you asking? I'm not doing anything wrong. It's like, we're not saying you're doing anything wrong. We're just trying to get to understand your business and how you're running your business. And then conducting a site visit. One of my favorite parts of the job of doing valuations because you get to go out and really meet with the business owners and understand their businesses. How are they operating? Where are they operating? You know, if it's a larger company, you can have a tour of the plant, which is exciting. But if it's a smaller company, it's still great to get out and see where you're operating. What does the facility look like? So the next step, and this is one of the really big ones, is normalizing your financial statements. And this is because you're going to do things in your financial statements that someone else might not do. So to get a third-party, transaction between third parties that aren't related, you want to know what could somebody else be running your business as completely separate from what you're doing. So we take your financial statements and we normalize your owner's compensation. Because maybe you're a small business taking home $20,000 when there's no way a buyer would be taking home that. Maybe the buyer would demand $40,000 or $80,000, depending on the industry. Or maybe you're taking $150,000 and an outside buyer or an outside manager could come in and run it for $60,000. So those are the sort of things that we look at. Looking at normalizing the compensation. What could you reasonably pay someone else to do the job that you're doing, irrespective of the fact that you're the owner? So that's really looking at how do you run the business as if you're not there. One-time and extraordinary events, that's important to take out because, if you have a flood in your basement of the business and you have to pay $20,000 to have that all cleaned up one year, that's not an ongoing operating expense. The business is worth much more money than, say, your bottom line of $0 because you spent all that. So we add that back in. That adds value to your business. And then discretionary expenses. These are big ones and they're often difficult to kind of pry out of people because people perhaps run things through their business that maybe they shouldn't for income tax purposes. Now, what's interesting is sometimes even if people are running it through their business, often, if you look at a set of financial statements, that doesn't necessarily mean they were deducted for tax purposes, but irrespective of that, you're again looking at what's discretionary. So, if you are running 100% of your vehicle expense through the company, it's reasonable to say that a new owner doesn't have to do that. Unless you're a company that, say, the flower shop example, they have vans that are delivering flowers. Sure, that's 100%. But you know what I'm saying? So if you have your personal cell phone and your entire cell phone bill is running through the company, that's something a new owner doesn't need to necessarily incur. And that adds value to your business. Because we're looking at increasing that bottom line. Your net income is, say, $10,000. Now we're adding back, say, another $20,000 from your extra compensation, and we're adding back another $10,000 from your personal vehicle use, and we're adding back another $5,000. That increases the value of your company. So you really want to be honest with yourself and think, what would a new owner have to do? What do they have to do to reasonably operate the company and get the revenue that you're getting? Next, we obtained some key industry data. Some of that is just looking. Risk Management Association provides financial statements, and did you or Amy mention it yesterday about the bank? Lenders will often have this information, and will just, you can say, oh, what's common for my industry, and they can print you off some normalized financial statements and some ratios, so you can talk to them about that too. But it's good to look at the industry data, see where's the industry going, what does the landscape look like for the industry, how risky is it? Look at key economic data. You want to look at both, international, but also just how's the economic data in Greenfield? Because maybe internationally things are horrible, but Greenfield's thriving for some reason. You have to look at that. It's different everywhere. Analyze evaluation approaches. Prepare your calculation, and then some sanity checks. So that's where I might use, say, the rule of thumb in doing a true valuation to say, does this kind of fall in line with the general industry guidelines? Perhaps looking at what's the payback period. If you were to sell your business for $100,000, you held back 20%, somebody put down 20%, and then they got a bank loan for 60%, what's the payback period on that? Do the cash flows support that? If not, maybe we don't have the right value. So discounts, the next thing you're going to see in the valuation is discounts. So discount for lack of marketability. So it sounds big, D-long. All it's really saying is you do not have a ready market for sale. You know, if you own Apple stock, you have a ready market for sale. You go out onto the stock exchange, somebody's going to buy your shares that second. It's easy, there's a market. If you have a flower shop here in Greenfield, there might not be a very ready market for sale. You know, you might be relying on an employee. You might be, so there's a discount for that. In our example, I just chose a random discount. I would say they can vary from, say, 10 to 50%. Most often you'll see them around 20 to 25% is very common. Discount for lack of control. Now this is when we're looking at a minority interest discount. So you're not going to sell, let's say, your whole company. And this is very common, especially for smaller companies. Maybe you have an employee that you're trying to groom to be a business owner, but they can't possibly buy the full amount. Either the bank won't lend on it, you're not ready to give up the control, maybe you still want to be involved, maybe you want to give them a 20% portion of the company. Well, it's worth less to them than 20% of the whole value because they have no control. They don't have say, you still own the company, you still have all the say. So there's a discount for that. So we take an added amount off of that value. And then key person discounts, I tend to put this more into the specific company risk section, but different valuators will actually take a discount, which is fine as well. Very common, especially if a key person has died or become disabled. But it's also interesting to note, how can you increase the value of your business? One way is to have insurance to offset that risk. So if the business has an insurance policy on you that they could replace you should something happen, that risk kind of goes away. So you might not have to take that discount. So we'll talk some more about what can you do to increase your value. That's one thing right there that you can do. If your business would be gone tomorrow if you're not there because there's no one else to run it efficiently, that's a way to mitigate that risk. Goodwill. The big elephant in the room, right? What is goodwill? Am I buying goodwill? Do I have goodwill? Unfortunately, a lot of people feel that I've been running this business for 30 years, I've put my sweat equity into it, I've put my time into it, that's my goodwill. And it's really not. What your goodwill is what the buyer says they will pay you for the business that's above and beyond the identifiable assets. So if we say, okay, you're going to sell the business for $100,000, you have $30,000 fair market value in your vehicles, you have $10,000 fair market value in your equipment, in your office, furniture and fixtures, and then that's it. That's all your assets. Okay, then you have $60,000 in goodwill. So you built goodwill. It was the value above and beyond, but it really has little to do with, say, sweat equity, or that it comes to the total value of business minus the assets you can identify. And it's a buyer side thing. It's not. The seller doesn't suddenly have goodwill. You have a tax implication from goodwill, but it's not on your books, it's on the buyer's books. So this is very important in negotiations. It's just like holding back paper. You know, you're going to negotiate at the end of the day. And this is what we often tell people, like, don't get a full valuation. Hire somebody like us, and I'm not saying us, hire somebody who does this work to help you negotiate these things, because you can make out much better in the end. And one thing you want to negotiate, how much goes to goodwill? It is great for a seller to have goodwill because you're taxed at capital gains rates. It's bad for the buyer to have goodwill because, not bad, but negative tax consequences, because they can only depreciate it for tax purposes over 15 years. If they're buying your assets, say equipment, they can depreciate it over 5 to 7 years, or maybe immediately depending on the current tax code. So that all comes into the negotiations. Okay, maybe we'll take more goodwill as a buyer, let's say, but we're going to pay less because we don't have a great tax implication on that. So that's part of the negotiations. There's that statement, I just threw it up there, but that's the statement that you have to file. Both parties fill it out saying, we agree, here's how we're classifying the purchase price, and you're attaching it to your tax returns. It has buyer's name, buyer's ID, seller's name, seller's ID, and that specific allocation. And then the big question, will banks lend on goodwill? Not really. I say that with a caveat though, goodwill often arises from the ability of the company's assets to generate cash. So if you have really good cash flow, and that's where the value of your business is coming from, the bank might lend on that. It's not to say they won't. It's just difficult. They'll often want to get SBA financing so that they have that 80% guarantee because they can't go and take building back. You know, if it's all based on cash flow, they don't have something to take back. And to be honest, the bank doesn't even want your building. You know, they want their money to be paid back. That's what they want. They want their interest. They don't have an interest in taking your customer list and then trying to sell it for money. You know, they just want you to pay for your loan. So will they? Yes and no. It really depends on the operations and what amount of a case you can make for how stable the company is. So here's our case study. So now we're going to take ABC Florists and we're going to look at the company's financials and say, what might this company be worth? So first, here's the historical financial data. So the balance sheet, I put up 5 years here. We really care about 1 year, right, on the balance sheet because that's the snapshot right now. I don't so much care that they had $55,000 in cash in 2011. I very much care that they have $60,000 now. And in negotiations, it's important to understand that when you're the seller, you always want to sell your stock or your interest in the company. And when you're the buyer, you always want to buy the assets. You don't ever want to buy the stock. You don't want to take on that liability. So I would say, even though there's those competing forces, it's almost always an asset sale. Not always, especially not in like family owned, but it's commonly an asset sale when you're selling the entire business. So we're saying this company has $217,000 in assets and $132,000 in liability with a net of $43,000. So, okay, that gives us our balance sheet. What does that give us? Our basic? It gives us our basic asset value, our basic book value, but missing an important aspect, right? The fair market value. We don't really think that the total fixed assets are probably worth $14,000.
It's hard to see the numbers, so it's good for you.
Is it? Good. Okay. So now we have the historic income statements. So we're saying this company is making between $960,000 to $830,000 gross income for this florist shop. The trend line though is going down. So the 960 was 2011, 12 it was 900, and it's consistently going down to the 830. If we go down to the bottom here, however, the net income is increasing. So their income is higher in the most current years. So why is that? Are there accounting anomalies? Could something be misclassified? Or have they truly improved their operations? And that's something where we'd want to sit down and truly understand these financial statements. What's causing that? So those are the historic financial statements. Now we want to normalize them. We want to say, what would these look like perhaps in the industry? First one, on this one, we're going to normalize cost of goods sold. So what happened with this company is we said, okay, your margins increased way too much. Your cost of goods just does not make sense. And they didn't think it made sense. So they weren't sure, were they missing a payable? What was happening? So we added $66,000 in cost of goods sold. And that brought them up to line. What we used was the Risk Management Association in prior years' data to say, what's a reasonable cost of goods sold? They should have been paying more. A third party would expect to pay more. So unknown why they didn't, but it's not fair to a new buyer to say they would have those efficiencies. It's just not there. Next one, we eliminated discretionary advertising. So you can see they had $20,000 in advertising. We're taking out about $5,000 to say maybe $15,000 is reasonable. So that again is a conversation. Maybe $5,000 is reasonable. Maybe it's $30,000. If you have a company that is a franchise, they might have a high advertising expense because they have to pay that to the franchisor. So you have to take that into account. We can't just necessarily say it's discretionary, but it may be. And again, you're looking at what could a new owner spend and still make the same revenue. So yes, we could cut out advertising, but no, you're probably not going to make the same amount of money. Discretionary meals and entertainment, almost always we say that's discretionary. You know, it really depends. You might have an industry where you must take out clients. Then it's not all discretionary. But in general, we usually can take that out. We eliminated half of the travel as discretionary. So again, that was a conversation. You know, what are you using for travel? What's going through that line? Let's add half of it back. A new owner wouldn't have to do that. Eliminate discretionary charitable contributions. So unless there's a good, really good argument for why it truly benefits the company and should be ongoing, you can usually eliminate charitable. And the reason I say that is, let's say your business is in Greenfield and there's the Greenfield Baseball Association, and you have given $500 every single year for one of the baseball teams. Your name's always on the shirt. That might negatively impact the company if a new buyer says, I'm not doing it. So you might want to leave that one in there. You might not want to take it out. And then normalize owner's compensation, which we already talked about. Normalize rent expense. That's another big one. You want to make sure you understand, especially if you're looking at another company, who are they paying rent to? If you're paying rent to yourself, you would hope that the rent is higher than fair market value for the tax benefits, or maybe it's less than fair market value. Maybe you can't afford to pay yourself a fair market rent. Well, a third party is going to have to pay a fair market rent. So you want to adjust it to that fair market value. So looking at the asset approach, so that's that first method. We already talked about, here's our net historic assets minus the historic liabilities. We have a total of $85,000 in value on the historic balance sheet, but we're saying a marketability discount at 25%, the value is $64,000. Now, is that a reasonable value? Almost never. Not only is the asset method often not the best value unless you're looking at a liquidation, but also the historic assets are at cost. They're not at fair market value. So it's important to remember that. I hear that a lot. Like, how do the financials look? Well, they have $200,000 in assets on the books. Well, do they really? We have no idea what that means. If you bought a building 35 years ago for $200,000, it's worth significantly more now. So you have to look at that. So on this one, we say, okay, what's the adjusted asset value? We added, I believe it was $60,000 to the value of the assets. We said those assets, fair market value, are $60,000 higher. And it brought the value up to $110,000. So that was the asset method. In this valuation, honestly, I wouldn't even have done this method unless it was a true full valuation, because we just knew the assets were more than the company itself, the operations. So capitalization earnings, which is the method that we used on this one, this is where we're saying, okay, let's take that 5-year history. This company, it looks relatively unstable because remember the earnings were changing, but the revenue was relatively stable. It was decreasing a bit, but in general probably stable enough to say that's indicative of the future earnings. So we came down with, let's use an EBITDA rate of 78.8. We weighted each year equally. And this is just, you could weight this year maybe less because the earnings are significantly higher, but you would need to look into it. We need to understand why it's higher. So now we look at, okay, what's the specific risk of this specific company? And here's some of the general items that go into it. The depth of management. How good is the management? Sometimes when we value a company, the depth of management might be very low. Let's say if it's an estate tax valuation, the major owner has just died and the other two owners are, say, sons that have only been in the business a few years. That would be a negative. That would be a risk. They don't have that depth of management. But maybe we're looking at a company that the depth of management, they've been there 20 years and they're going to continue in the company. That's excellent depth of management. Here we said nothing. We didn't weight it at all. We said it is what it is. They're good. They're not anything to be super risky, nothing to give a premium on. Importance of your key personnel. Diversity. Now this, looking at the specific company risk, this tells you a lot about how can you increase the value of your company now. So think about where your company stands. These are the things you can do, some of the things. Increase your depth of management. Try to develop that key manager, let's say, who's in the business, who might continue in the business. Make it worth their while to be in the company and to understand the operations. kind of falls in line. Key personnel, diversification of product line. That's a big one. So if you're an automobile repair shop, maybe you only repair BMWs and you have a niche. That's great, but you're going to be much more valuable to somebody if you repair, say, all automobiles or all sedans or something of that nature. Diversification of your customer base. That's a big one. If, 80% of your sales are by 3 major customers, that's very, very risky to a new buyer. Because maybe that new buyer loses one of those customers. They don't have anywhere near the income that you had. So the more you can show you have a diverse customer base, the better it is for a new owner. It's, an accounting firm is a good example of that. We could have, say, 3 major audits, or we could have 5,000 small tax returns. Both are good business, but if you're looking to buy, the audits are risky, because if you lose 1 major audit, whereas if you lose 5 tax returns, not a big deal, get 5 more. So you're looking at that mix of the customer base. Diversification, stability of suppliers, that definitely comes in more typically with larger manufacturers. So are they relying on one manufacturer in China, and if that goes under, they don't have somewhere to get their product? That's what we're looking at there. It could be a factor here as well, but less common with smaller companies. Geographic location. So is it hurting you somehow being only here in Greenfield? Is there a way to expand a bit and maybe have your sales go out further? And maybe that's not a possibility. That's fine too, but it's another thing that could increase your business. Stability of your earnings, that's a big one. It's very important to have stable earnings. So how can you make your business more stable? How can you show your financial statements, even if it's just a couple years improvement, to show that your earnings are stable? Your margins that you're getting, your financial structure, and then you come up with our specific company premium or risk. The higher it is, the lower the value. And we'll look at that. So this is the buildup of the rate. I'm not going to bore you with the details of building up the rate. We already talked about what goes into it, but important here we see the industry risk premium was negative 1.03. That's saying that it is less risky to have a florist shop than it would be to, say, have a different kind of industry. We used a growth rate here of 1% into perpetuity. So we're saying they're going to increase some, they're not going to increase at the rate of inflation, but they're not going to remain flat either. So that gives us our rate. This, I'm not going to bore you with the details. This just says, I told you we were using an earnings before interest, taxes, depreciation, and amortization, EBITDA. That's not the appropriate final method you want to use. You want to have a cash flow, an after-tax cash flow. So this is adjusting to that. We're just adjusting our cash flow to earnings. We're adjusting to a pre-tax basis. So don't worry about this. Just know that it's out there. And one thing you want to know is you want to make sure that the person valuing understands the difference. You can't just use one factor. You have to understand how the cap rate affects that factor and whether you're using it correctly. So, what does this come down to? We had said our earnings before interest, taxes, depreciation, and amortization were just under $80,000. We set a growth rate of 1%. We have our capitalization rate of 13. We have our marketability discount of 25. We're saying the value of this company is $452,000. So that's using the first capitalization of earnings method. Now let's do a quick, this is almost a sanity check in this one, and I'm wrong, there's one New Hampshire company in there. Now we're saying, let's look at BizComps data. So BizComps is one of those databases that you can find out transactions that have already happened. So I went in the database. There's 13,000 transactions reported on total. When I narrowed it down to flower shops, it was 144. I narrowed it down to New England, and there was only 2 transactions. So I said, okay, that's not enough. Let's go with the Northeast, and there's 9. So again, this is not apples to oranges. You'd really have to look at each one of these sales and the factors behind those sales and the companies to understand whether this is comparable. It's just, in my opinion, more of a sanity check than anything else. And if you see, Pennsylvania apparently has a lot of flower shops that sell. But this gives you something, another kind of sanity check to see how your business would compare to other businesses that have been sold. So what this is coming down to is a price per the seller's discretionary earnings that we talked about, 1.41, and the price per revenue, 0.42. We take that down, we have additions of assets and liabilities, our value is $290,000. Another major sanity check that we talked about, these are our rules of thumbs we had earlier. Okay, so if we base it on annual sales, we have a value of $310,000 at the highest point. Remember, it was 30 to 35%. If we base it on the EBITDA, it's $158,000. So see how wide-ranging that can be? That's why it's not a good method. It's not a method evaluation. Just can kind of give you that sanity check. And you'd want to look, well, why are those so different? Maybe there's something in my EBITDA calculation that needs to be changed. Not in the EBITDA itself, but maybe in those normalization of earnings. Maybe I'm not normalizing something properly. Okay, so these were these do-it-yourself websites that I had not used before this, as I had mentioned, but it was interesting to see. So Fit Small Business, we were able to put in florists. We were able to put in the $800,000 in sales. We were able to put in the $150,000 of owners' salaries, so sellers' discretionary earnings. And they came up with a value of $328 based on sales, $260 based on profits. That's the one I would say is probably using a rule of thumb. It came out very close to rules of thumb. Exit Advisor is the one that did not ask for an industry at all, which is interesting. But it came out with, here, you should, if you're placing it for sale, you should ask up $510,000. Reasonable, not reasonable, I don't know, but it certainly is better to shoot higher if you're actually putting it out there for sale. So I wouldn't say that's necessarily a negative. But know that, your value is probably going to come down to the $300,000 to $450,000 range. So just kind of fun tools to use. Now, effects of changes. So here was our value using a capitalization of earnings, a true valuation method, the $450,000. What happens if you increase your earnings, your EBITDA, by $10,000 and increase your value to $510,000? So that's something you want to look at now. What can you do to be increasing your earnings, increasing your bottom line? It's going to increase your value. It's more valuable for a new owner if your business creates more cash flow. Next step, we increase the sustainable growth rate. How can you do that? Maybe you want to be doing more advertising. Maybe you want to have a more solid advertising plan in place. Maybe you don't have a website, and a website would increase your earnings. That's a way you can look at the growth rate. Increasing your growth rate by 1% per year, increase the price to $491,000. So it's a $40,000 difference. And if you're looking at the percentage, that's a big increase. It's not insignificant by any means for a smaller company. And then the last one that I played with, so to speak, was I changed the capitalization rate and said, this company has higher risk because of another factor. In that company-specific risk, I increased that, and it brought the value to $423,000. So that goes to show you how important it is to really look at the company itself. How risky is your company? How stable is your company? Those factors make a big, big difference in price. Remember, though, another important thing to remember, we're talking fair market value in general when we're looking at this. Fair market value does not mean that's what your business is going to sell for. Your business might sell for way less or way more than fair market value. Some of that will just depend on the buyer that comes along. Often it's a synergistic value. Maybe your business is worth more to that person down the street because they're going to have efficiencies they wouldn't have had without your business. Or maybe there's no buyers in the market and you're going to have to sell for less and just hope to get out. There's a lot of factors to consider. There's the factors of, are you holding back paper? Are you not holding back paper? That doesn't really have to do with value. That has to do with your selling price. Your selling price is going to change because of those. So that's one of the reasons I suggest to people, you don't need a valuation to sell your business. You need someone to help you understand the value and help you negotiate your selling price. Because value is not necessarily going to equate to your selling price. It may be completely different. So we've already talked about these, but we'll kind of go through a little bit. How do you increase your value? Depth of management, key personnel. diversify your product line, customer base, stability of earnings, geographical, increase your cash flow. Big one. Decrease your debt. That increases your cash flow. So you can have more sellers' discretionary earnings if you have less debt, if you have more cash that could come out to future owners. So that's another plan you can start working on. Buyers want to see a strong cash flow and an increasing cash flow. They don't want to see that your debt is going up, because that means you're financing the operations with debt. That's not a good sign. Lenders don't want to see that either. Product and service differentiation, we already talked about. So what I'm going to run through next is some more of those rules of thumb, just because I think they're fun for people to understand what those rules are. Even though we say, oh, they're not a real valuation method, they certainly help in trying to understand your business. So this one's just, we'll start with the first one. Auto part and accessories, a retail store, tend to sell at 40% of annual sales plus inventory. Retail businesses in general. So often we'll see something like an auto parts store that we can specifically identify, but oftentimes there's not a rule of thumb. So okay, what's the general rule for retail businesses? 1.5 to 3 times sellers' discretionary earnings, 30 to 35% of annual sales, 12 times your EBITDA. Again, remember, these are just real rough guidelines. They're not valuation techniques. They don't substitute a valuation if you need one, but they're certainly helpful guidelines for businesses. Auto repair, 20 to 25% of annual sales, 3 to 3.5 times EBITDA, 3 times sellers' discretionary earnings. And it's interesting because we'll often run these just if somebody is looking at buying a business, we'll look at, in general, what does the industry say? And as you saw with the florist shop, each of these can bring up very different values. So maybe you average them together, maybe not. It might not be reasonable. You need to understand why they come up with different values or different estimates of value. Printing, silk screening, 3.5 to 4 times. That's EBIT, so earnings before interest and taxes. It's not taking off the depreciation and amortization. Although they're interestingly saying EBITDA is the same. Seller discretionary earnings, annual sales plus inventory. Auto transmission centers, 3 times EBITDA, 35 to 45% of annual sales plus inventory. So seller's discretionary earnings, the reason it's so much lower than EBITDA, right, is because you're adding back the money that the owner would take out. We're saying that's cash flow to a new owner. That's the other reason to decrease debt, too, is that even though the new owner is not buying debt, they need to know whether the business can operate without that debt. You know, they're clearly going to have their own debt to buy it, but what's the ongoing operations? We'll often see that the ongoing operations are being supported by either line of credit increases, credit card payment increases, credit card debt increases, the owner's putting money into the company, that debt is creeping up, so maybe the company looks like it's surviving, but it's really not. Beer and wine stores, 4 times monthly sales plus inventory, so that's an important one. That's saying you're looking at the sales, but you're adding the inventory at the end. And what we'll typically do is we'll have a fair market value count of the inventory at closing. So what's that value at the closing date? Because you can't really rely on the seller's books for inventory. Sometimes it's pretty close, but oftentimes it's not. It's just an estimate. The last one, this comes into more of the businesses that don't have any inventory, accounting firms, law firms. They tend to go for a higher fee, like 90 to 100% of annual revenue. A lot of the other ones we saw, 20, 30, 40%. But they're risky, and you often want to hold back paper. In that, you don't want to hold back paper. The buyer wants you to hold back paper because they want you to have some skin in the game to make sure it transfers well. If you have significant operations, efficient operations, they want to make sure that you're going to give them that knowledge and help them with that. Another way to get more money out of the company, so to speak, even if the value of the purchase price isn't there, is to stay on with the company, have a consulting agreement for a couple of years. So you get a couple more years of additional income while helping them to make a good transition. So that's often a good selling point. Sometimes a new buyer says, no, I don't want you around, I know everything and I can do it myself. But that's typically not the case. Usually buyers are smart enough to know you've been running the company, you know the systems, you know the operations. you can run it efficiently. And now we're here for questions. Any questions? Any specific industries you want to talk about? First, you want confidentiality agreement, because you don't want them to be able to disclose, or a non-disclosure agreement, first off. You don't want to give somebody else your financial information without them saying they're not going to use it. And then I would say if it's a truly serious buyer, you could just provide, say, 3 years of tax returns or financial statements if they're CPA prepared financial statements. In-house financial statements often don't match the tax returns or aren't adjusted properly, so that's a little more suspect than a tax return. Or if you're at the real initial stages and you don't want to give them that, do kind of a listing of, here's the sales over the past 5 years, here's the cost of goods sold, here's our net income, here's our seller's discretionary earnings, so what were you able to take out of the company? You know, I paid myself this. Well, on one of those negotiations we had, the seller took out $15,000 a year, and we said, okay, so you must be getting money under the table. You know, you must be not claiming your income. No judgment here. We're not accusing you of anything, but the buyer wants to know, because that adds value to the buyer, not value that you're going to get as a seller because you didn't claim it. You already kind of got your benefit of that. But a buyer would want to know that, and they said, no, we're not taking any money out. We don't have any cash coming in on the side. We're like, how are you paying your bills then? You know, I don't understand. So you want to be able to show them that. Here's what you're getting out of the business, because that lets them know what they can get out of the business. If you're looking and thinking to sell, start claiming your cash. Even if it's slowly, even if you don't want to raise big red flags, start claiming your cash. Because you're not going to get the value of that. It's a selling point. You might be able to sit in a negotiation point like, hey, you can afford this because there's this extra cash we didn't claim. But it doesn't add to your value at all, because you already got the benefit of not having it on your income taxes. If you can't show that income on your books, the buyer can't assume it was really there. So start adding that in if you're taking it on the side, because it'll benefit you in the long run. A little more tax now, but a lot more in value and potential purchase price later. You can, yep, I would say especially the asset portion of it, but yes, I would give the balance sheet. Even more importantly than the balance sheet, a listing of your assets. So what's the estimated fair market value of your assets? Because that's really what's important. You can give them the balance sheet. If they're doing an asset deal, they're not taking on your debt, they're not getting your cash, so what are they getting? Give them an asset listing of what they're going to be getting, and you can ignore the balance sheet, essentially. Again, it comes down to the value of the cash flows. So what's the income you're able to generate from that customer list or from those contacts? That definitely adds value, and that's a company, I would say, that's worth more than a company without those contacts, absolutely. Again, it comes down to what's being generated from that patent. However, that patent has specific value. It costs somebody money to create that patent, and nobody else can use that patent for a certain amount of time. So that absolutely is valuable. And that would look at not only the cost of it, but what's the future economic benefit of it. Because you're buying, say, another 10 years of nobody being able to do that product. So that adds value. What might you earn in those 20 years or 10 years? Whatever's left. It's still coming down to that, what are you able to generate in cash at the end of the day? So, and it's hard for people to understand that, but that's really where it comes down to for the buyer. What can you do with those assets in order to generate cash flow, in order to generate business?
I always have trouble with the capitalization versus expense. I can buy a whole bunch of new equipment and not make any money, but I can show that I made a lot of money if I capitalize, set those expenses
Correct.
off.
Correct.
And it doesn't even show up. It looks like
That's right. That's one of the reasons we want to normalize those financial statements. And you want to say that to a buyer. Okay, my net income at the end of the day is 0, but here's why. I bought all this equipment. It's one of those extraordinary expenses. You're not going to be spending that. You already have that in there. You're adding that back into the cash flow. That's right. And if it's on the balance sheet and you depreciated it, you're still adding it back. There's still that fair market value of that equipment. And again, though, don't mistake, though, some industries, if it's like, say the accounting firm, you're buying our customer list, let's say, our employees, so to speak, and you're going to get all our assets with it, right? So let's say it's worth $100,000. You're not paying $100,000 plus our computer systems and our software, because our computer systems and our software are what made it worth $100,000. That's included. So that's where you've got to really look at the industry and the type of company and whether the assets add value at the end or whether they're truly pivotal into the operations. So leasehold improvements is a tough one because you spent X amount of money upfitting wherever you're renting from, and really the value at the end of the day is going to the owner of that building, right? You can't, if they're not something that you can detach and take with you, you can't really sell it to a new buyer. You might be able to negotiate a better purchase price, especially if they're able to get a good lease rate, maybe a longer term lease or a lease on good terms. Maybe some of that value transfers to them because they'll be able to use it. But in general, you're losing that value at the end of the day. You did that, a new owner cannot take that and bring it down the street to a new building. So that's tough for some businesses to understand when they go to sell, that they're not recapping that back. It's kind of like having your house and doing, you know, an $80,000 kitchen renovation, but your house increases only by $20,000 because it doesn't matter that you wanted all the top-notch things. It doesn't increase the value. The next buyer didn't need to have that. What I would probably do is just take your report and put it into an Excel document and then add back at the bottom. So, you know, throw your profit and loss into Excel, say here's your net income, and then start adding back, normalizing, and saying, okay, add back $10,000 in rent because it went to yourself, or change your owners, and then you can see at the bottom how you changed it. You could use the budget section in QuickBooks, but it would be a little more misleading just because it'll show as, you know, here's your future budget. Whereas if you put it in Excel, you can truly show how you made the changes. There's one thing with deals, people want to be, you want transparency. You know, you don't want a buyer to think that you're hiding things because it just gets it set off on the wrong foot. And we've had that where we've gone in and we've said, they're hiding something. You know, we can tell they're hiding something, and the broker's like, no, they're really not. That's just how they behave. You know, it's just how they act. They're really not. So the more transparent you can try to seem, the better the deal's going to go. So we represent buyers oftentimes. Sometimes people will come to us almost at coming close to a deal. Hey, I'm looking at buying this business. I think it might be a good deal. I'm not positive. And sometimes the broker or the lender at the bank will send them to us to say, help them out, consult with them a little bit to see if this is worth it. Or somebody like the CDC or SCORE will say, go talk to them for an hour and help them, let them help you negotiate. Or oftentimes a seller will come to us or be a client of ours and say, I want to sell my business, can you help me? So we really do it on both ends. Yeah. And it's important, in a true valuation, so if you're looking at a valuation for estate tax purposes or divorce purposes, there's one fair market value. There should be. I mean, it might be a range of values, but it should be a fair market value. When you're looking at selling, if you're engaging me and you're the seller, I'm going to be advocating for you to get a higher price. I'm going to be working with you for a higher price of your business. And if you're a buyer, I'm going to be looking for you to get the best value for your money. So those are competing interests. You know, I'm not looking at just a fair market value and a fair price for all. You're truly advocating for the side that you're working for in a merger and acquisition context.
So this is a slight aside, but so
Yep.
solar PV systems that are leased have a section where they can be sold back or to some, you know, the owner of the house at fair market value. Is this the same terminology? Does it have the same definition?
Yes.
For the IRS? Okay.
It does. So it's what it would exchange hands between a willing buyer and a willing seller. That's right. That's the fair market value. Yeah. And that's why it may or may not be the actual selling value. So you might have the solar panels and say it's worth $5,000, but you're willing to get rid of it for $3,000 because you want to, or you want more for some reason, and if someone's willing to buy it. So it might not equate to fair market value, but if you're truly looking at fair market value, and that's in the contract, you want to go back and say, what are these truly worth right now in a third-party market? A willing buyer, a willing seller, nobody's forced to buy, nobody's forced to sell. Because like, say you're willing to take $3,000 for $5,000, maybe you're being forced to sell. Maybe, you know, there's financial hardship or something. That's not a willing buyer and seller. That's a force. Real estates are typically at capital gains rates. It will depend on what's involved in the property. There could be depreciation recapture. We'd have to look at specifically what's in it. I would say though, it's important to note, when something says it includes inventory, like even just looking at the general rules of thumb, it doesn't include real estate. Typically real estate is a separate deal. It's usually owned in a separate company. But if it's owned in the same company, it would be above and beyond the value that we've talked about. We were talking about value of operations. The real estate is separate and it adds additional value. Yeah, that could be valuable. We talked with somebody yesterday who had prime real estate property with a nice view. The area was nice. And does that add value to the business itself? Well, yes and no, but where that adds value again is the cash flow, because someone might be more willing to go there because the atmosphere was so nice. So it really depends on a few factors. One, what are you looking to try to get? So if you really want to be done with the operations but are looking for some, on top of selling the operations, you want some known cash flow and some value. You want to know that, okay, I'm planning to retire or I'm planning to go into a new line of something that interests me, but I want that $30,000 a year coming in from the property. You might want to hold that property, or maybe you want to give that property down to children or something, but you just don't want the operations. You could do it separately. Maybe you want to just be completely done and get the highest value, sell it all. But another consideration that often comes into it is that the bank is going to be more willing to lend on the building. So it might be your best way of selling the operations is by selling everything, because a bank is more likely to finance if it includes the building. So sometimes that has to come down to the negotiations again, but you might want to just to be able to make the deal viable. Oftentimes people will sell only operations and then rent the company. The rent income will supplement their Social Security, let's say, or maybe a pension they had, and then they can more comfortably retire than if they could on just selling the business outright. So that's a very common strategy to go into retirement. You know, build a nice business, have the building, and then rent that to the business that you sell. Yeah.
But could you also do like a lease to own on a building, so you're still getting revenue for the building
Right.
over
But eventually
10 years,
the owner, right.
and that actually could help the seller,
Yes.
the buyer.
The buyer. Yeah.
With whatever, you know, gap financing they need. And
Correct.
And the owner would still get continual revenue. I mean, I think that it sounds like, you know, there's just so many strategies out there.
Right. Right.
That you could weigh them all,
Yeah.
and evaluate them all to each other.
Right, exactly. And that's where it helps to really get that second or side opinion, you know, whether it's a valuation specialist or it's your accountant or a lawyer or somebody, though, that understands negotiating. Because another thing we find is that when we or another third party is at the table, it's easier to negotiate. It's often harder for you to negotiate your own business. It's easier for me to come in and say, hey, that doesn't make sense, our seller's not willing to accept that, or our buyer's not willing to pay that, than it is oftentimes for the owner to do that themselves. There's some lawyers that specialize in M&A, again, merger and acquisition. Now, if you're looking at a big law firm, yes, do be afraid of the term, and because it does mean bigger dollars. But if you're looking at a smaller law firm, it's just like looking at a smaller CPA firm. You're not going to be paying huge money in order to have them represent you, but you want them to have knowledge in buying and selling businesses. Yeah, that's very important. Even more, I would say, well, I don't want to say more important, but in the negotiation portion of it, more important than them having the real estate background, because you're going to get a real estate appraisal. You're going to know the fair market value of the building, but you might not have the negotiation for buying or selling the business.
So you would ask for someone with merger and acquisition experience?
Correct. Yeah. Or they might say, if they don't specifically pose it that way, helping small business startups might be a way to word it for a little bit smaller, but merger and acquisition, that's really what you're looking at. Yeah. And business brokers, they can be a good avenue for if you're selling, but they take 10% typically off the top. That's a huge chunk of money, especially for a small business. That's a lot of percentage to go out the door right off the bat. So
in a realtor would take 6%.
That's right, a realtor will take 6% off the top. So you might be better off, hiring that accountant or that valuation or that at an hourly lower rate than paying a broker. Not to say, you might want a broker, you might need a broker. If you have a bigger business, I would say absolutely, you probably want to do it, but, well, not necessarily. Again, it depends. If you contract with the right people, you might not need to, but you really need to sit down and weigh your options and understand what you're looking at. So, and it can't hurt to interview people, get a feel for whether it's someone. You can have 2 brokers or 2 valuation people, 2 CPAs or 2 lawyers that every single one of them could charge the same amount, but you just click better with some of them. Someone's going to be a better fit for your personality, a better fit for what you're looking for, and that might be who you want to go with. It's typically a tax advantage. I should say I'm not giving tax advice here, but no, yes, as a CPA, I can tell you it's typically a tax advantage because you're going to pay, the income is passive income, and you're not going to be paying self-employment tax on that, so it's a better tax benefit to you, which is why oftentimes when you're looking at financials, you're paying more than fair market value rent because you want that money. And really for IRS purposes, depending on the type of entity, let's say you have an S corporation, they want to make sure you're taking a fair wage. So you can't just pay yourself all in rent and not take a wage. They want to make sure you're doing a fair portion of paying that self-employment tax, but yes, it's absolutely a tax benefit.
That's great.
All right. Well, thank you very much.